Stock market loves rate cuts. And are we going to get one in the middle of June when the Federal Reserve Committee meets to make the decision and releases the dot plot? Find out in today's video. What's up, everybody? Jeremy Ricks here. Courage pays better than fear trading, with part one of my video series getting into the Federal Reserve meeting that's taking place here in June. It's super important, and that's why I'm covering it 3 times to prepare you, to educate you, to let you know typically what happens leading up to the meeting, what typically happens when rates are cut, and what it means for your trading and investing. We're also going to take a look at what happened when the Fed cut in the fall and winter of this past year to see what happened so that you can use that to your advantage in your trading. And I'm also going to give you 3 key things to watch leading up to the Fed's decision so that you are prepared for what is to come. Fed's next meeting is June 17th and the 18th of 2025, and it's a big one. Why? Because the Federal Reserve is releasing their dot plot, a chart showing each Fed official's projection for interest rates. Right now, the federal funds rate is at 4.25% to 4.5%, where it's been since the last cut in December of 2024. But markets are buzzing with speculation about more rate cuts, and one that may in fact come this month in June. The market is expecting 2 quarter-point cuts by the end of 2025. That would bring the rates down to about 3.75% to 4%. But here's the thing. The Fed just doesn't cut rates out of the blue. There's a buildup. Weeks of economic data, Fed speeches, and market reactions that set the stage. And with inflation still above the Fed's 2% target, last reported at 2.6% in March, and unemployment near 4.2%, the Fed is walking a tightrope. Add in things like tariff noise, increasing unemployment as mentioned by Fed Governor Waller in his comments, and you could see why markets are on edge for this meeting. But what typically happens in the weeks leading up to a rate decision meeting? First, economic data will take center stage. The Fed looks at inflation, jobs, GDP growth to decide if the economy needs a boost. Leading up to a rate cut, you'll often see mixed signals and market uncertainty. Right now, core PCE inflation is at 2.6%, above the Fed's goal of 2%. Some economists think that it'll cool off soon, which leads to optimism for a rate cut this month. Second, Fed speakers start dropping hints. We'll hear from folks like Jerome Powell, who just spoke on Monday at 1 p.m., or Governor Waller, who said tariffs might push unemployment up, paving the way for rate cuts later this year. These speeches often move the markets. For example, back in April, Jerome Powell's comments on supply chains sent the SPY up 3%. And traders hang on every word from Powell and the Fed governors. And as a result, it moves the markets. And third, markets get volatile. When rate cuts are expected, you'll see the short-term Treasury yields dip. Some sectors like tech may rally because of cheaper borrowing costs. And let's take a step back and look at what happened with the 2024 rate cuts and how that impacted the market. First, the fall 2024 rate cut. On September 18th of this past year, the Fed cut rates by 50 basis points, and it brought the federal funds rate from 4.75% to 5% down to 4.25% to 4.75%. What led to this? Inflation was cooling. Core PCE was trending toward 2%, and the labor market was softening. Unemployment at 4.1%. The Fed started to have growing confidence in inflation progress, but there was debate. Fed Governor Mickey Bowman dissented, preferring a smaller 25-point basis cut, the first governor dissent since 2005, and markets were mixed leading up to the cut. Tech stocks like Nvidia rallied on hopes of cheaper borrowing, but financials lagged. After the cut, the S&P 500 initially spiked 1.5% as investors cheered the Fed's move, but volatility followed as some worried that the cut signaled a slowing economy. What about the December cut? Since you asked, then came the December 2024 cut, and on December 18th, the Fed cut rates again, this time by 25 basis points, bringing the range to 4.25% to 4.5%, where it stands today. Inflation was still above 2%, around 2.5%, but the economy was cooling, with GDP growth slowing to 2.8% in Q3. The dot plot in December showed the Fed expected only 2 more cuts in 2025, which surprised markets. They were hoping for more. And what happened after that? Markets plunged. The S&P 500 dropped 3% the next day as investors worried about persistent inflation and a hawkish Fed. Mortgage rates also rose, jumping 100 basis points over the next 3 months. And as a lot of people pointed out, the Fed really has limited control over long-term rates, and their power really is only over the short-term rates. Rate cuts don't always mean a smooth ride. Markets can overreact, and sectors respond differently. Tech might rally, but if the Fed signals fewer cuts, like it did in December, expect a pullback. Let's talk about what this means for your trading in June of 2025. Based on what we saw in 2024, here are 3 key things to watch. Stay until the end of the third one because it's a game changer. So we have key economic reports. In the next 2 weeks, watch for CPI, Consumer Price Index, and the PPI, Producer Price Index, and retail sales data. If inflation cools further or unemployment ticks up, we'll get that on Friday, like Waller suggested with tariffs, markets will price in a higher chance of a rate cut, and stocks could rally just like tech did in September of 2024. And also pay attention to Fed speak and market sentiment, and pay attention to what other Fed members are saying. If he or other Fed members sound dovish in the coming weeks, hinting at cuts, you might see a market bounce. But if they're hawkish, like in December, expect selling pressure. And track the S&P 500 and sectors like tech for clues. Here's the third thing. Don't go anywhere. I'm about to share the biggest thing to watch before the Fed's decision, and it could save your portfolio. Third, and most important, the dot plot expectations. The dot plot is the Fed's crystal ball. It shows where they think rates are headed. Now, it suggests rates could fall to 3.75 to 4% by year end. But if the June dot plot shows more cuts or sooner, markets could go wild like they did after the September 2024 cut. The lead up, watch how traders and investors are positioned. Are they betting on 2 more cuts the market expects or more? Use tools like the CME FedWatch to track probabilities. It's a goldmine for traders. That's it for part 1. Next week, I'm going to break down the Fed's latest signals and how to position your trades before the June 17th meeting. Don't miss it. Subscribe now and hit the bell so you get notifications when that video is released.